Hey traders, this short little video is going to cover some of the changes that are occurring in the retail Forex market. New act called the Dodd-Frank Act, and yes, same Barney Frank that said that the Freddie and Fannie were doing fine. Same guy. There's been some changes that have come down the pipe to deal with the retail Forex trader themselves and also the brokers. This short video is just going to cover the changes that you, as a retail Forex trader, are going to have to know and understand. Now, this really applies to the U.S. citizens and those that trade at a U.S. brokers. If you're trading outside of the U.S., this is not really going to apply to you. And also, if you're trading with a broker that's not covered under the CFTC. Okay. So, let's just talk about what is this. Basically, it's a Wall Street Reform Consumer Protection Act. Now, what they're framing this as is basically just a consumer protection act against brokers and et cetera, et cetera. That's how this is being framed, as a way to protect the consumer, the trader. Originally, we were looking at 10-to-1 leverage. That is what has been spouted about. There was a huge campaign to ensure that 10-to-1 never saw the light of day. And so what's happened now, the CFTC has settled on 50-to-1 for majors and 20-to-1 for exotics. Now, for the most of us, this exotic one is not really going to matter. This one up here covers a lot of the pairs that we all trade. The standard pairs that the pound US, the euro US. And right now, the euro yen's there, the pound yen's there. So for the majority of us, unless you're trading something like the Thai baht, I wouldn't worry too much about 20-to-1. Their CME has helped author portions of what was this bill, and which is now the act. And not surprising, retail Forex has grown immensely, has taken some of the thunder away from their futures market. And we all know the CME has now offered mini future contracts as well, trying to entice people back in. So no surprise that there was a little bit of their input involved in this, pushing people back towards futures. And one thing that's in this that's pretty scary is the way it is now is one thing. But this can be revisited on an annual basis. So while right now you're looking at 50-to-1, that could drop. All right? When do we ever see things go up when it comes to the government? We don't, except for taxes. But and here's something that's been bandied about, and I haven't found any proof of this whatsoever. However, it does not surprise me if down the road this becomes truth. The fact that U.S. residents won't be safe simply by shipping off their money to a offshore broker. For example, FXCM has a UK branch. You will not be safe by shipping it off to them. There'll be a little concept called the extraterritorial, which means if you're a U.S. citizen, these rules are going to follow you around. It doesn't matter where you think you're going to go. You'll have to come back. Now, that's just a rumor. I have not read this. Would it surprise me? No, not at all. We all saw, if they would have got a 10-to-1 leverage, we know what would have happened. Mass unemployment when it comes to brokers and people that work for these trading firms and the broker firms, and how much money would be leaving the States. I've heard upwards of $1 billion in lost revenue, et cetera, and the job losses, and who wants that? But, that's probably why this 50-to-1 is the way it is. But that's probably, I don't know for sure. But a lot of people bandied about that with a 10-to-1, you're looking at a mass exodus of money from the States. Now, I still wouldn't be surprised if, people that are really upset about this decide to start selling the U.S. dollar and devaluing it even more. But for a lot of us, this 50-to-1 is no big deal. I've traded everything from the 400-to-1 down to the 100-to-1, and currently I trade 50-to-1. So this is absolutely no change for me. I'm in Canada, but I trade out through a broker in the States. So this doesn't matter to me. This doesn't affect me whatsoever. But it does affect a lot of people that are used to 100-to-1. And so, basically, what does this mean? What it's basically going to mean is you're going to require some more capital in your account to trade. Okay? That's basically what this means. One of the drawbacks of that is I personally know quite a few traders that have a pretty large trading stake. And they don't just trade it through one broker. They separate it up into a couple different brokers. The problem with that now is they're going to have to deposit more funds into a broker. So now those guys that I know that have been trading with two brokers, in order to continue trading the way they're trading, are going to have to take some of their funds from one and put it into another. Now, we've heard this line, too big to fail, right? When it came to some of these institutions that went under. The one thing that is a bit of an issue is putting all your eggs in one basket. Who's to say, even though they've got these new standards for brokers, that they won't go under? We don't know. So you're going to have more of your money in one individual broker. And if that broker goes under, good luck getting your funds. So just keep that in mind. That's an argument that's been bandied about as well. Here's a quick example. Previously, if you wanted to buy the pound US at $1.54.46, and you wanted to buy $100,000 worth of that currency at 100 to 1, right? You have to put in $1,544, right? 1%. Now, 50 to 1. You want to do the exact same transaction. It's going to cost you in margin $3,089. All right, that's not chump change, right? That's a lot of money for a lot of people. There is one good thing. There is going to be more rules for brokers, right? So that, if you look under the consumer protection, perhaps that'll make a difference. But, they can put all the, requirements they need. Too big to fail, we've heard that before. So all the rules, all you want, it doesn't mean that you're much safer. And this is my opinion anyhow. You will draw your own. So a lot of people have asked, well, why are they doing this? Why? Well, the problem is, they're going to hype it a whole bunch of different reasons. The bottom line is to save traders from themselves. Now, what's happened over the years, as retail Forex got, bigger and better, we had all these different, robots, et cetera, spouting how you can make all this money, and people got their hopes up, right? Dreaming big. So when they found that, hey, you know what? I can have a $5,000 account and I can trade a ton of money, upwards, $300,000, $400,000. Well, the fact is, that was the problem. Traders thought they had that money available. They didn't realize, one of the keys of being a successful trader is how you manage your money and risk management. You don't have that down, you're not going to succeed anyhow. So the problem was this trader would have a $5,000 account, right? He wanted to trade 3 standard lots. That's how much he could trade. Now, I've done the math already. I've rounded it down, right? He thinks he can trade 3 standard lots because he's got $5,000. Here's the problem. Let's say he's taking a 30 pip stop loss. Those 3 standard lots are worth $10 a pop, right? $30. It's down $900 if this trade stops out. We all know we're going to lose in Forex, right? Or any trading venture, you're going to lose. You're going to have your losses. This person just took a $900 hit. 18% of their account gone. Now, is that the margin requirement problem? Is that the leverage problem? Or is that the trader problem? It's a trader problem, right? When people found out how easy it was to get into Forex trading, anyone with a MetaTrader account could fire up their internet 24 hours a day and start trading their money away. And that's what happened. The solution is for this trader with that $5,000 account is to calculate 2% of his account, not what he can trade, not the margined, not the leveraged amount, right? But 2% of his actual on-hand cash of $5,000. That 2% is $100, right? 30 pip stop loss. This person could trade $3.33 per pip, so 3 minis. So how much would this cost? For 100 to 1, right? It would have been $463 up in margin. That's how much he would have had to put in. That's how much would have be taken from his balance and put aside to handle this trade. Now this same trader has to put up $926.70. So what does this mean? Well, this trader, perhaps he's got a rule that he can only have X amount of dollars, X percentage available and live in the market. Well, this trader now can no longer do that. Maybe this trader can no longer have, let's say he wanted to do this, and he wanted to buy the euro and something else. And maybe he's already in a swing trade. Well, the problem is now they can't. They've got to trade less. Now, what if this solution trader is a professional trader? This guy's not a joke. He's not some rookie who thinks that $25 is going to make him a millionaire next week. He does everything right. The problem is these traders that got into this market that are unprofessional in their attitude and their approach have kind of ruined it for so many other people that take this as a profession. Now this trader, the problem trader, this 50 to 1 is not going to make a difference at all. A trader that keeps on losing and doesn't understand the basics of risk management, they're going to lose regardless. Doesn't matter what you do. Maybe a 50 to 1 is going to be a slower bleed, but soon enough they'll be on the sidelines, looking in, saying, "Hey, you know what? They said they were going to protect me. Well, they didn't, because I'm still out my money." It would have been nicer if they're going to put regulation that you have to have, some sort of course or something under you. Obviously, I wouldn't want that either. I don't think that's right. But if you talk to any trader worth their salt, first thing they're going to say is it's because of this. And it's to save you from yourself because the government knows best. And on the flip side, it's going to, under the consumer protection aspect of it, it may make, brokers a little bit more transparent, et cetera, and that'd be fine. But this is what's going to affect the retail trader. I'm sure that there's a lot of traders that are going to be up in arms. Now, personally, I don't find it to be a big deal. Leaving aside all the problems with, government regulation, who actually wrote up this bill and this act, who's responsible for it, regardless of all that aside, this to me is not a big deal. You can still get better leverage in the spot Forex than you can anywhere else. So in the coming days, you'll be getting emails from your broker, if you haven't already, outlining some of this stuff right here. But you know what? For the most part, for a lot of the traders I speak to on a daily basis and email with, they're not going to have much of a problem with this, simply because a lot of them are trading where I am trading. So 50 to 1 is not a big deal for them. So that's that. Please be aware of this. That's coming out. You're going to be knowing it pretty soon. That's for sure. So now is a good time to really go over your trade plans, just to make sure everything is what you've got in your trade plan for how much you're going to trade, how many positions you're going to have, and what you're going to do. Just make sure you've got that all tightened up and you've got the money to cover that. One thing you don't want to start getting, because you didn't do your homework, is margin called. All right, so that's that. Hope you picked up something from this video and understand a little bit. Do some more searching for it. But this is probably the gist of what I'm concerning myself with, irregardless of being in Canada. It doesn't really matter to me where I'm at. I still want to be educated on this kind of information. All right, so good luck.